Two insurance companies can report similar profits, but one may be taking dramatically more risk than the other. Why? Because accounting profit alone doesn't tell you much. That's just the reality. To really understand an insurer's financial strength, you need to understand capital, and more specifically, the difference between regulatory capital versus economic capital. Hello, everyone, and welcome back to the channel. My name is Diego, and here we discuss quite a bit of FP&A, insurance finance, and the strategic mechanics behind how insurance companies really operate. In the last video, we talked about capital allocation between underwriting and investments, a very good topic to, get to know. And today we're diving into one of the most misunderstood concepts within insurance finance, I would say, which is the difference between economic capital versus regulatory capital. So grab your cup of tea and let's dive into it. Now, to kick things off, why this matters? At a first glance, these concepts sound very much similar, right? So we have both relating to risk, both relate to solvency, and both relate to capital strength. But they serve very different purposes. And understanding the differences are very critical for strategy, risk management, performance evaluation, and long-term decision making. Because one is mainly about satisfying regulators, the other is more about understanding the real economic risk of the business. And what is regulatory capital then? Let's start for this one. Okay, so this is the amount of capital an insurer is required to hold by regulators. And its main objectives is protecting policyholders and maintaining financial stability. In simple terms, regulators want insurers to survive stressful scenarios. So they establish capital rules and solvency requirements, and insurers must comply. The important point is regulatory capital is standardized, okay? So it follows prescribed frameworks and formulas, which means it may not fully capture the specific risk profile of a particular company, okay? It's very, very standardized, very generic. Now, what is the economic capital? Economic capital is very different, a bit different. Instead of focusing primarily on regulatory compliance, economic capital tries to estimate the actual amount of capital the business needs to hold according to its exposures. So this includes underwriting risk, market risk, credit risk, operational risk, catastrophe exposure, concentration of risk. And unlike regulatory capital, economic capital is internally driven, okay? So it's a strategic management tool. Its purpose is not just survival, it's understanding risk-adjusted value creation, basically. Now, the key differences, okay? Here is the simplest way of thinking about it. Regulatory capital asks, are we compliant? The economic capital asks, are we taking the right amount of risk relative to return? And this distinction changes everything, because a business line may look attractive from a regulatory perspective, but economically, well, it may destroy value once risk is fully considered. Real-world strategic impact now. This is why sophisticated insurers rely heavily on economic capital models, okay? They use them to allocate capital, evaluate profitability, price products, assess strategic expansion, and optimize portfolios as well. Because ultimately, the goal is not just to meet regulatory requirements. The goal is to generate sustainable risk-adjusted returns. So, to close things off, I would say regulatory capital keeps insurers solvent, which is necessary, okay? Economic capital helps insurers make smarter strategic decisions. And the companies that understand both well usually outperform over long term. In the next video, we will explore how reinsurance itself becomes a capital management tool, not just a risk transfer mechanism. Follow the series if you want to understand insurance finance beyond the surface level. Thank you so much for your company today, and consider like, subscribing to the channel, and follow along. Let's sharp our craft together. Let's do it. Thank you for watching. I'll see you in the next video. Bye.